Hello and good morning, everyone. Welcome to yet another edition of TC Live, a very special edition, in fact. I hope everyone had a great break for those based in Nigeria and perhaps other African countries that observed the Muslim break 3 days ago or over the last 3 days. So yeah, welcome to another edition of TC Live. It's really very exciting to be here. And on this edition, we're going to be talking about the State of Tech in Africa report for Q1. The theme for today's conversation is charting a path to profitability. And I have very amazing people on on the panel who are going to join me in having this very interesting conversation. Unfortunately, one of our panelists could not make it to today's call just at the last minute. But yeah, we're going to have fun with it as we go along. My name is Kelechi Njoku. I am TechCabal's managing editor, and it's really exciting to be your host today on this edition of TC Live. Just quickly, I just want to welcome Davy and OM. So two of the panelists who will be joining me today are Davy Ngugi, who is head of channels and production at TechWiz, based in Nairobi, Kenya, and OM Akban, who is head of investments, Seed Fund 2. Just a little about our guests today. So Davy is a seasoned entrepreneur and consultant with over 12 years of experience in startups, product management, customer experience, and partnership development. And currently he leads channels and production at TechWiz. And OM Oemakwan is the bridge between founders and funders in Africa. He provides strategic insights to entrepreneurs seeking funding and investors looking to maximize their returns in Africa. He is currently the head of investments at Launch Africa VC, a leading venture capital firm specializing in early stage African startups, and the host of the Grinders Table podcast, where he profiles founders, innovators, and domain experts disrupting Africa. Davy, OM, welcome to TC Live. It's lovely to chat with you.
Thank you, Kelechi. Hi, everyone.
Yeah. So without further ado, let's get into the business of the day. So like I said, in my opening, today we are going to be looking at the state of tech in Africa. And the state of tech in Africa is a report that is a quarterly report that we do by TC TechCabal Insights, which is a bird's eye view of technology trends in Africa. It captures data around acquisitions, funding, startup expansion, and regulations on the continent. For this edition, we spoke with stakeholders in the ecosystem to put the data into proper perspective, effectively turning them into actionable insights that you can make use of. And our theme for this Q1 edition, like I said, is charting a path to profitability. And TechCabal Insights, for those who do not know TechCabal Insights and TechCabal, so just a quick word about us. TechCabal covers the business and human impact of tech and innovation in Africa through high quality articles, reports, and events like this. We also publish the TC Daily newsletter, which is a comprehensive roundup of tech news and events across Africa. If you're not subscribed to it, the link to do so will be posted in the chat room so you can sign up right away. And this event is organized by TechCabal Insights, the events, research, and data analytics arm of TechCabal. They are an Africa-focused digital economic consultancy that leverages big data to help startups, investors, operators, big tech companies, government, and other ecosystem players on and off the continent to answer specific questions and implement key interventions. And just while we're still on TechCabal Insights, I've got exciting news for you. TechCabal Insights now have their own website, right? So they are now making it easy for you to find your favorite data stories and reports. So to get the State of Africa report today, that's the report we're going to be discussing today, visit insights.techcabal.com. To get the report, the State of Tech report that we're going to be discussing today, visit insights.techcabal.com. You should find the link to the website in the comment. So before we get into the meat of our conversation, I'd like to invite my colleague Mobolaji to talk us through the State of Tech in Africa report for Q1 2024.
Hi everyone, good morning. Can you hear me?
Hi Mobolaji, good morning. Yes, I can hear you
Hi,
perfectly.
good morning.
Hi, how are you doing?
Hi William, hi Dave, and everyone on the call. I think we can go straight into it. Thank you everyone for joining in. So I just want to run us through a brief part of the report itself, which we presented in slides here. So here, let's get to the first slide. So one thing that is, I think it's obvious to everyone now in Africa's tech ecosystem and the digital economy is that funding has seen a gradual reduction or continuous decrease in the last 3 years. So if you look at the chart here from Q1 2022 to Q1 2024, funding has dropped from about $1.5 billion to less than $500 million. Next slide, please. So when we go through funding breakdown of funding analysis by sector, it's interesting that fintechs did not raise the most amounts this quarter. Logistics and transport startups raised more in funding compared to fintechs, but it's very important to note that Move's Series B funding round of about $100 million skewed these results in logistics and transport startups advantage. So we have a case where fintech had more deals and more deals compared to other sectors, but logistics startups, based on the fact that Move raised over $100 million, which is the only mega deal from this quarter, ended up having the highest amount in funding. And it's also interesting to note that Move has raised over $460 million in funding. I think they're now valued at about $750 million. And the total funding they've raised year to date is about $250 million equity and $210 million in debt financing. Next slide, please. It's interesting that my last word was mention of debt financing. It's also great to note that debt financing made up 28% of total funding from 19 deals within the quarter. So I think in the last about 2-3 years, we are beginning to see debt financing becoming an asset vehicle for startups on the continent. And it'd be interesting to see how that plays out in the coming quarters and in the coming years. Next slide, please. So we move over to mergers and acquisitions. Mergers and acquisitions actually increased this quarter. And it's also evident here that fintechs received or had the most frequent mergers and acquisitions in African tech. There is MasterCard's $200 million minority stake investments in MTN Momo, the fintech division of African telecommunications giant MTN. And then there are other startup sectors which are represented once in the chart. Next slide, please. So something else that we noticed this quarter, and I think anyone who has followed the mergers and acquisitions trend in Africa's tech ecosystem for the past 2-3 years would know that South Africa is most, it's where merger and acquisitions activity happen the most in African tech. So South African startups were acquired 5 times. So there were about 5 acquisitions from South African startups compared to Egypt and Nigeria that had 2 apiece. So next slide, please. So despite the fact that funding reduced and we are seeing like a steady flow of acquisitions in the continent, it doesn't seem to be that startups are slowing down in expansions. Q1 of 2023, there were about 4 expansion events. In this quarter alone, there were about 9 expansion events. And while we could say that both acquisitions to about 5 different markets skewed the advantage, even if you take out 4, it still beats the 4 from last year's Q1, from Q1 of 2023, rather. So next slide, please. And so when we put it all together, the fact that funding has dropped, acquisitions remain steady, especially with fintechs, debt financing is becoming a preferred vehicle for investment to startups. It just makes sense that profitability has become something that is now commonly mentioned in the ecosystem. I know last year was unit economics, or 2 years ago. But from this slide, we see that Time Bank rebounded and posted a profit from its Q4 2023 financial reports. Swivel also posted a profit. Jumia reduced the operating losses. And if you go in depth into the reports, you get a sense of, you see a chart that shows the stock price performance of Jumia and Swivel in the last 1 year. And this is based on the fact that they are beginning to see a path to profitability for Jumia in terms of reduction in operation losses, and Swivel, which actually posted a profit in Q4 of 2023. And also we see MasterCard's partnership with Mono boosting the fintech API startups' race to profitability. And so next slide, please. Okay, thank you. And so in summary, we've seen that funding continues to drop. Acquisition remains steady even as the bearish markets in Africa's tech ecosystem persists. Startups are orienting in expansion, and of course, they are trying to gain more revenue and expand on their market share. And then the final point is that startups and tech-enabled businesses are beginning to focus on profitability following the funding downturn, which leads me to handing over the conversation back to Kelechi to moderate, and let's hear from our guests on how profitability becomes achievable for startups in Africa. Thank you.
Thank you very much, Mobolaji, for that beautiful summary of the report. Mobolaji is our data analyst here at TechCabal Insights. So if you want to download the report or get access to the report he just walked us through, once again, go to insights.techcabal.com, insights.techcabal.com. So I am just going to walk us through the agenda of this conversation, which you should see on your screen right now. Sorry, I feel like I have. Okay, cool. So for the agenda for this call, for this live, so we already had our introduction and report presentation. So we're going to have a conversation for 30 minutes with Davy and OM. And then for another 30 minutes, we're going to have a Q&A. So this is an invitation for you to drop your questions in the Q&A box while we converse. Now, the Q&A box is different from the chat box. So you have to drop your questions in the Q&A box. Otherwise, we're not going to see the questions. And then, of course, we're going to have our closing remarks at the end of everything. So once again, Davy, OM, welcome to this conversation. Yeah.
Thank you.
Yeah, cool. So I guess my first question is kind of like just really broad regarding the state of tech in Africa right now. So, and it's just for the both of you. So what key events were the highlights of the quarter for you? Davy, can I begin with you?
Yeah, sure. Thanks, Kelechi. Good morning, everyone.
Hi, good morning.
And good afternoon, I think, from different time zones. So one of the things that stood out, especially in this quarter, is that there has been a very huge, just as the report has been able to capture, decline in the amount of funding that has been available for startups within the African ecosystem. Of course, this is largely attributed to many factors, including the global economic downturn. And for a lot of startups,
you're rather muffled, so it sounds like you're slightly underwater. So, yeah, so if you could check your microphone.
Is that a bit better?
Not quite.
Okay, just
maybe if you projected a bit more, then it would be it'd give us a much brighter sound.
Is that better now?
Yes,
I think
it's much better. Yes,
okay.
Please
yeah,
go.
So I think I'll just recap. So as I was mentioning, you rightly captured within the report that for this quarter, one of the things that stood out has been the decline of funding, especially for startups within the ecosystem. And a lot of it has had to do, of course, with the global economic downturn. So for startups that are within the African system, they've had to figure out their journey towards profitability. Because otherwise, without taking that kind of direction, a lot of them would end up just going underwater. And I think that has also led to as you rightly noted, a lot of acquisitions, because for a lot of startups that are unable maybe to survive, going for long periods without the funding for their growth, then the natural direction for them would either to be shut down or for them to get acquired by larger, more mature startups. I think I'll take a pause and let OM also give you.
Thank you, David.
Yeah, thanks.
It's been an interesting period generally. There's now a drive for profitability. More founders and more investors are insisting on founders going back to the drawing board and focusing on their business models and ensuring that they actually build businesses that one can survive these crazy times, and then secondly can scale in a manner that, we're beginning to dump that whole idea of blitz scaling, but scale sustainably, right? So ensuring that while you're drawing back and cutting down your costs, but you're also growing at a sensible rate month on month. We still see that most of the investments are going into the big four, in quotes. And I'd just like to pause here and also give a shout out to TechCabal. Your report is actually quite comprehensive. And for everybody that is on this panel, I think you should download that report because it gives key insights into the ecosystem. We also see that there's quite a number of investments in the logistic space. I reckon that because more investments are going into climate tech and e-mobility, we're still going to see quite a number of investments in that logistics sector. And for the time being, we're going to see more money, although it was quite skewed by Moo's investment. We'll still see more investments going to that e-mobility logistics sector. And of course, fintech would always get a lot of investment because across the continent, it's still difficult to access financial services to move money seamlessly for various reasons. And then I think finally, I'd say that businesses, because they're focusing on surviving, we're going to see quite a number of pivots and quite a number of mergers. Now, on paper, these mergers might not look really big, right? You're not going to get that announcement of $100 million, acquisition or a merger. But what we're going to see is more founders figuring out that they can consolidate efforts, consolidate their companies just to survive this funding winter.
Thank you very much, Wem. That was a very comprehensive roundup of the situation here. Thank you, Davey, as well for your thoughts. So I want to ask this, right? So Time and Swivel, they turned in a profit for the first time in Q4 of last year, while Jumia, which is Africa's e-commerce giant, reduced its operational losses, laid off workers, and shut down its food business as part of its plan to become profitable. Now, given the harsh macroeconomic conditions across major African markets, how long can they remain profitable despite the headwinds? So this is about Time, Swivel, and Jumia. how long can these companies remain profitable? Davy.
I think one of the things that we're seeing is the refocusing of these businesses, especially towards their core functions, which would build more profitability. And the biggest example is Jumia, which despite not yet having achieved profitability yet, we're seeing them, on a very strong drive to be able to move towards that. It's a key function of their growth prospects. And we see them now beginning to get their closing. They're closing a lot of their funding. They're closing out a lot of the businesses that are not providing enough profitability, like the food business, which is one of the largest loss-making functions for them. So we see them now also shedding a lot of their workforce and restructuring their portfolios, closing down things like logistics as a service, operational costs. This will help them to achieve profitability, at least in the long term. So I believe that this is actually a good direction. We've seen the same also with people, removing such things like the free, services that they were offering, which are largely for these businesses tends to be a huge money pit for them. So them being able to get some of these services out of the way, which are practically loss-making and driven towards advertising and marketing, then these companies will, I think they can continue to be able to move towards that path for building profitability. So that's my initial thoughts.
Thank you, Davy. OM, do you have anything to add to that?
Yeah, interestingly, I had the former CEO of Jumia Nigeria on my podcast some time back. And one of the things he talked about was how, there's a cost for being number one, first entrant, and then there's a cost for blitzscaling and trying to expand yourself to reach other markets. I think that achieving profitability is a major milestone for these companies, Jumia especially, given how much they've been running losses. But the key for them would be figuring out how to consistently maintain that profitability quarter on quarter. And given the whole macroeconomic headwinds across the major cities in Africa, like currency devaluation, like with reduced consumer spending, it's definitely going to put more pressure on the margins that they managed to scrape in this period. So I think for them to maintain this profitability, there has to be relentless focus on cost efficiency and the basic unit economics, right? All the typical freebies that they'll give to customers, but they probably would have to cut that back, focus more on their supply chain and getting the most bang for buck that they can. But what's important to note is that at the core of everything, you can say that they build businesses that have fundamentally sound business models. So they can actually scale this. Even though growth might be constrained, given all the reasons that I've listed, I think that they have the potential and they have the capacity to actually maintain this profitability quarter on quarter, despite all the volatility.
Yeah, that's a great point. So I want to ask a question that takes us a bit back to a few years. So we've always known that profitability is important when proposing businesses or when funding businesses or starting businesses, right? So what is it that went wrong before now, such that investors just didn't seem to put a lot of pressure or intense monitoring on whether a business is going to be profitable, and then suddenly now, after the pandemic and lockdown, everything is over, it seems like we're coming back to this fundamental lesson? What would you say went wrong at some point in how we understand business in the tech space? OM, would you like to have a go at that? Then I'll come to you, Davey.
It was a myriad of reasons. One, the cost of capital was quite low. We at that period, we're having zero interest loans. So people had so much money to invest in things. Two, and I would say that venture capital happened. And while I'm an investor, I understand the role that we played in some of the things that we see now, right? And this is not because there was an intent to, pile on cash into companies, but there was an intent to show that Africa, you could exit businesses on the continent. And so there was this pressure to grow, 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 grow. And this pressure was put on the founders to do everything possible to burn as much cash to show they can grow, so that Western investors can see Africa as an opportunity to make money, cash out. But what eventually happened, that it became more like a pyramid scheme, right? You pour in cash into something, you wait for the next investor so you can get your money out, and everybody keeps on looking for who to hand over the bag to. So I'd say that there were good and bad sides to it. In the end, we need to remember that Africa's ecosystem is still very nascent. A lot of things that we're experiencing now are not new, and there are many other ecosystems that have gone through the same phase. So there was so much insistence on, making sure that companies scale beyond their communities, scaled across the continent. There was free cash, right? And when there's free cash, everybody assumes that you should just make use of the money that is available to you. Unfortunately, there's just negative sides to it. But I'd say one thing, that even though there was this deliberate drive for companies to scale really fast, really quick, it showed that it could be done on the continent. It showed that technology could be used to scale businesses. It showed that there was a ready market for businesses that were meeting core needs, that were, targeting their markets appropriately, and were doing the right things in terms of building the right company cultures and all that. So again, there's so much opportunity within Africa. And once this phase we are in, goes, we will still see companies begin to grow rapidly across the continent.
Yeah, cool. Davey?
Yeah, I think WEM has captured it quite well. A lot of those macro factors that have really affected how the availability of capital have changed over the last couple of years, last 4 years, since the pandemic, moving into the recession. That availability of funds is no longer the same. Also seen there's huge shift in investor forecast, where now they're looking at more mature companies that have a bit more proven kinds of a track record or models, rather than the previous avenue where investors were willing to bet on different or new and novel kinds of ways of doing businesses. So now we see investors looking towards the companies that are also growing. The other thing is also that lack of a lot of successful exits has also made investors begin to rethink how they're investing in businesses. A lot of businesses tend to just gobble up most of the cash that is given to them by investors, but at the long run, they end up being just under the table acquisitions, or ending up pivoting into new avenues, which tends to be a bit wasteful for investor capital. So a lot of these factors tend to now affect how that capital is now actually being invested within the continent. And there's also the natural, corrections that have happened, where now investors are becoming selective. They choose where to invest rather than trying to also be part of the gravy train that was there before, where everyone wanted to be part of it. Just like Wem said, it was almost like a pyramid scheme.
I'd just like to quickly add one thing. The other side to the continent being discovered by Western investors is that they began to, there was so much money available to businesses that it might not have made sense to local investors, right? Don't forget that as African VCs, we still are answering to Western LPs, because that's where we raise most of the money. And as such, we sometimes have to act in their interests, meaning that if an LP loves a certain company, you eventually might have to invest in that company. So I'm just giving a bit of backstory to the action of some investors. However, because Western investors were pouring, without local presence, without local knowledge, were pouring money into certain companies or founders, because they were type matching, right? Because the founder maybe spoke a certain way, went to Harvard, had a certain access in their network. It became the norm. And then the fear of missing out made people just keep on investing in those companies without actually, the local investors showing people that, so trying to rephrase this, instead of the ecosystem investing in companies that were proven by local investors, what happened was that more investment were going to companies that were backed by Western investors who hadn't done as much homework, who didn't understand the local terrain, and who could not support the companies appropriately. And so that might have factored into why, there was so much money being poured into various companies that even at the surface, some of us could tell that it wasn't going to last.
Yeah, I can imagine.
Yeah, and that brings up a new way of looking at it. We've also seen the change of the type of investment that is now available in the market. Previously, there was a lot of equity investments happening within the region. But now we are seeing a very huge shift towards debt investments, where now, basically for you to be able to earn that debt, your financials really have to look reasonable and have to show that you're on a path to actually achieving profitability and proper growth. So that means that not a lot of companies now qualify for the kinds of investment that we used to see before. So that means there will be definitely a reduction in the amount of money we are seeing in the ecosystem.
Yeah, thank you for your thoughts there. So speaking of corrections, right? So which is something that you brought up, David. So that just leads me to my next question, right? So now given this downturn that we're experiencing and the need for startups to be profitable, what steps would you suggest startups take to attain profitability in the early stages? So I'd love to hear from you, and then I'll hear from Uwem.
For any startup really to be able to be profitable, and also grow, the first and most important aspect is to have proper product market fit. So being able to have a product that actually has a place within the market that consumers actually want and actually need is pretty much one of the most important aspects of being able to just grow and now be able to fit into an area that investors would feel comfortable engaging with you. Because in the early years, we saw a lot of startups that we could say were more of trying to find a place. So you build a product and you send it to the market and you hope for the market to accept that product, which now as the ecosystem matures and as the market also becomes leaner in terms of availability of funds, we now have this for anyone that is looking to build their existing startup or start a new one. They really have to take those fundamentals into mind. The other thing is basically looking at how to build what would be the lean startup, where you're basically taking away any function or anything that does not provide towards the profitability of the business away. You do not want to have a business where you have necessary workforce or headroom, or where you have unnecessary services that you're having on your back end, freebies and so on, because this will all be a detriment to you being actually able to build a startup that can be sustainable in the long run.
Uwem, do you believe that?
Yeah, thank you, David. I think you covered quite
the answer.
Yeah, you've covered quite a lot. But before I even answer that question, I'd like to say for founders that are looking to start businesses, or if you have an idea and all, please don't start a business based on a hunch. Don't start a business based on who you think the target market is. Don't start a business based on just a need that you experienced. Please let there be a ready market willing to pay for your products or services. I see a lot of decks every day. In the last quarter year, I've seen I've received not of, I mean, when I look at our deal flow system, I've seen over 700 companies come through. And then sometimes you see people do a serviceable, obtainable market, 100 million people, I'm like, where will you, how? But you're not selling, but then again, your product is a premium product. Who is going to pay for it, right? So at the core of everything, please don't build a business for just yourself or your friends. Build a business that has a ready market that is willing to purchase whatever you're selling. So exactly like somebody said in the chat section, do a proper market research. But I think for startups to reach profitability faster, they have to be very ruthless. I know that using the word ruthless might sound unfair, but you have to be very ruthless and do more with less. And that means cutting non-essential costs. That means figuring out ways to extend your runway. That means prioritizing high margin revenue streams. I was looking at so sorry, a call is coming in. Yeah, okay, I'm back. I was looking at a company last week, and something they did really intrigued me. What they did was that they looked at all their customers within the last 3 years, which of them were transacting above a certain threshold, and focus marketing on them because those were their high value customers. So prioritize your high margin revenue stream and the customers that actually bring the bulk of your money. Maybe implement the 80-20 rule, put 80% of your effort on those that bring the money and then 20% on those that don't bring, the most revenue. I think you have to be highly disciplined when you talk about growth. So if your goal is to increase 10% month on month, are you readily reviewing your strategy? Are you readily watching your burn rate? Are you looking at your churn to ensure that you're hitting your targets? And then maybe potentially slowing down your expansion and focusing on your core markets or core products. So we've gone from that era of blitz scaling to actually just ensuring that wherever your core market is, you are a winner there. And then maybe figure out alternative revenue streams, maybe upsell products to people, maybe figure out creative ways to extract more value from the customers. And maybe finally you can pivot to something else, to another market. So if it's not working for you, if you've done everything that you can do, please, you can pivot to another market, but pivot to a market that you have an understanding of and the management team sort of has expertise in, because then if you go build a new business that, you don't understand the industry, you're just setting yourself up for failure.
Yeah, cool. Thanks, OM. So from what the both of you have just said, I want to believe that you're on the same page with Piggyverse CEO, who said charge from day one recently. Charge your customers from day one.
Absolutely. Free. So I think for most fintech founders, I'm beginning to see that that freebie era doesn't necessarily work.
Yeah.
Start charging your customers from day one. If you're doing a trial, it could be just a 1-day trial or something. Just figure out your pricing at the very beginning. Obviously, pricing can change over time, but it's always oftentimes harder to convert people that are used to free services than people that are, you've charged a bit for trying out your service.
Yeah.
That's absolutely true. There's the popular saying, there's nothing like free lunch. This stands absolutely true, across the world, whatever sector you're in. We have one of the best examples of one company that fell towards that problem, and now they really have a hard time building. Jumia was known earlier for being the, almost like a discount store, the place where you go to get things that are heavily discounted or free things. And that makes it very difficult because the customer begins to build customer perception that you're the place for freebies, you're the place for discount, rather than you're a certain kind of a business. As Wem has said, charge from day one. If you have to provide, a free trial, let it be, very short term and very targeted. Don't make your customer think this is something that they can get from you. Because if they think that that's the way you do business, then you're also building a culture
Yeah.
of free things, of things that they can get easily, and that will hurt you in the long term.
In the long run, yeah. So so speaking of business pivots, which is something that OM just touched on, I want us to stay a bit on that and just drill down to it. So now business pivots, right? They continue to shake up the ecosystem, and it's a trend that we've noticed from Q4 last year. So my question is, how crucial are these pivots, and what are the common pitfalls startups face when making these decisions? So I'm going to start from you, OM, and then go to Davy.
Like you said, we're going to be seeing more cases of pivots. Again, it's part of the entrepreneurship or entrepreneurial journey. It's actually very, very important that founders begin to consider pivot when it just looks like nothing is working. Especially founders that have raised money. It just looks like, there is no direction, there's nothing. I think that some common pitfalls for people, who are deciding to pivot is when they're just moving too slowly and burning through cash. When you know that pivoting might solve part of the problem. If you're burning through cash, if your runway is reducing really fast, and there is no solution to solving the problem of converting customers in the space that you're in, I think a pivot is absolutely necessary. Interestingly, I was talking to OO, I don't know if some of you know OO, and he was saying that people underestimate the power of actually failing and starting again. Sometimes you have to ensure that a startup does not outlive its life or its existence. And one of the good examples he gave was Shola Akindele of Paystack, who his previous company, he had an internet company previously, and that died out, and he built Paystack. But if he, pushed and kept on building that previous company, he probably would never have built Paystack, right? So sometimes that at the end of life, you just have to pivot or close down the business. But I also want to mention that it would be crazy if you're deciding to pivot and decide to pivot into a space where the founding team has no experience in. It will be absolutely atrocious and just a recipe for failure. Also, I think that fundamentally, when you're pivoting, you should ensure that you're pivoting within your startup's core vision, right? What were you trying to solve? I'm assuming now, if you're saying if you're initially when you started out as a founder, because again, one of the things that I like to look at is your intrinsic motivation. What led you to build this? What were you trying to solve? What is the mission you're trying to and vision for whatever you're building? And if it was maybe say improve the welfare of African youth, an assumption, and you were doing that through a fintech platform, but it didn't work. But you decided to pivot to say an edtech platform that upskilled workers. You're still within the same vision, right? You can still tie that back to the vision. But I find that sometimes founders pivot away from what motivated them, what their core vision was, and it ends up in failure because it's just like you're pivoting for the sake of pivoting. There is no motivation to really build in that space, and there's no skin in the game. And then finally, please do not pivot without communicating with your investors and key stakeholders. So it could be the regulators, it could be your customers. Please, 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 please. Because again, you're setting yourself up for failure. Ensure that when you're considering a pivot, one, you have the conviction, just to round up all things I've said. There's a clear logic behind why you're actually pivoting. If you have investors on your cap table, there's a buy-in from them. And then lastly, you actually understand the market that you're pivoting into. You've done your market research, you understand the market realities, and the team is capable of building in that space. I'd like to end by giving an example of a founder, the founder of Remedial Health. Many of you don't know he had a startup, pre-COVID, which was a SaaS system. And basically during COVID, he woke up one day, I remember that call very well. I said, you know what, I've spoken to Kola, I'm speaking to you. I want to pivot. I'm tired of the way the COVID's effect on Nigeria is affecting me. I'm a pharmacist by training. I want to build a health healthcare startup, right? Now, this was a huge, course correction from where he was initially. But one of the reasons why we as the investors supported him was that we knew, one, he had skin in the game. He already had experience in that space. Number two, he understood the market. He had done his research. He didn't just say, I'm pivoting for the sake of pivoting. He listed out, this is where I'm pivoting. In my previous life, I had this business, and this is what I could do. With this, I see that I can do X, Y, Z. I've spoken to these people. These are my first set of customers. Like, he had done all this research. And so pivoting was easy for him in that sense because there was an investor buying, and investors were willing to also support him on his pivot journey. So it's very, very important that you do all these things before you even attempt pivoting or as you pivot.
Thank you very much, OM, for that very detailed take on pivots. I really like what you said about, using motivation as your North Star to pivot, because I think that was something I was worried about while I was asking this question, that okay, if someone just pivot just because of the money or just because there's a market there. But yeah, I think I like how you explained it, that
Yeah, but if your motivation is to make money and exit, see, I'm going to be real with you. Then do it. See, what I don't want us as, African entrepreneurs and African founders to do is lie to ourselves. And if your motivation is to make money, if you grow up poor and you're saying you want to move your family out of poverty, that is a strong motivation and that would drive you towards success, right? But what is wrong is you pretending that that's not your motivation and making decisions because you don't want people to know that that's your motivation, right? There's nothing wrong in telling an investor, sorry, I've dragged this along, say, see, I'm going to build this startup till my Series B, and from Series B, I'm looking to exit. Like, prepare, and everybody knows this is what you're going to do, and we'll work towards it together, right? Some investors will not like that. Some would actually appreciate it. The most important thing is that you're true to yourself.
Very true and very well put. Thank you. Davy, what do you think?
One of the biggest risks when it comes to pivoting is pivoting when your company is almost dead. It's a dead fish in the water, and that makes you make very risky pivot decisions because then you haven't thought them through, and what you're trying to do is fighting for survival. And at the end of the day, when you do that, you typically will make it very rash into an area that you haven't either thought out quite well or into a space where the founders have literally no experience, but because you think that would make money or because you saw your friend also doing the same thing. So it's very important that as you're making the pivot, it's important to realize quite early in your runway, while you still have time to be able to keep moving, that this is the best time to pivot. Things are not working. It doesn't seem like there's much that is going on. This is good time because it actually buys you time to also sit with your team, with your investors, and just think through what you're thinking of pivoting into and think whether it's something that could actually make sense. And most of the times, the most successful pivots tend to be from areas within which, while you are running this business that seems to be no longer working, you found an opportunity in. It's not a whole new stranger entire avenue. One of the most successful pivots in history is that of Nintendo. Nintendo was originally created as a playing card company. They would make cards for games, but they successfully pivoted into a video game company, which, as we clearly know where Nintendo is today. Usually you pivot into areas which are not so far from what you were doing in the previous business, but into an area that you might have discovered an opportunity that you maybe never thought of in the very first time. Yeah.
Thank you so much, Davy. And my final question is on debt financing. So obviously, debt financing continues to grow in terms of preference as an asset class for startups year on year. So how sustainable is debt as a financing vehicle for startups compared to equity financing? Davy, and then I'll move to
the place for debt within a business, and this is for both a mature business and also for a startup, it rings true both ways. Debt places a new kind of responsibility for a business which was previously not there, because debt is not just about the money that you receive from the investor or the financier, but also the interest, which now is something which previously didn't have to deal with. When most of the times when an investor comes into your business through equity, what they're looking for is the same thing as you, to be able to upsell that business into maybe a later stage and be able to grow that initial investment. But there isn't a responsibility for you to be able to give so much in return on that initial investment, apart from that which is gained through the growth of the business. So anytime a business is thinking about investment, especially debt investment, they have to think about how they're going to repay that debt and their interest, which is maybe monthly, annual, whatever the terms. Interest comes at you really hard and fast, and if you're not careful, that is actually what might end up sinking your business. Even for a business that was actually on the right path, debt can actually sink the business if you've not thought through the fundamentals of how you're going to deal with that debt, because it grows really fast. It grows faster than it would grow through an equity kind of investment. However, debt is also very good because debt allows you to be able to scale a business without you, letting go of valuable capital. So if you have everything that is important within growing the business, being able to have constant revenue, being able to take care of how the business is able to be run, not having too much money being let out, then you are able to use debt to be able to grow the business quite fast, and it can actually be a very good avenue for a business to move on into a path of profitability and also growth into the future. So it's quite important for businesses to consider debt, at the same time be quite aware of the risks that come with taking it into the business.
Thank you, David.
I think David has said it all. I depending on where you're building and what stage of your business, I think that figuring out how you can combine debt and equity as part of your overall, fundraising strategy, including grants, is very, very important. Again, we're in this phase, we want to survive, right? So any opportunity that gives you non-dilutive capital is good to explore, and debt is one of them. Grants are one of them. I just don't want people to become who I call grantpreneurs, who all they do is just pitch to grant organizations. But I digress. What is very important for startups at this moment is to keep an eye on the interest rates, because interest rates are growing globally. Even though, in the US and in the UK, the central banks have held on to interest rate, but they're still quite high. Especially if you're raising, from the Western world, you're raising in, foreign currency, in dollars potentially, and the local currency is, constantly being devalued, and there's a lot of volatility. So if you keep an eye on you have to keep an eye on the interest rates. One, two, try to raise debt locally, because with high interest rates and FX volatility, there's a lot of pressure on the potential repayments that you will have to make. I think that because debt burdens your cash flow, you have to pay regularly. It can actually threaten your survival, right? But I like debt because why? Every month you wake up trying to figure out how to pay back. Unlike with equity, where most founders just go to sleep and assume things will get better. So debt is surely an option. I think that there are various types of debt you can look at. Now there's venture debt, there's asset financing, there is revenue-based financing. There are companies offering revenue-based financing. There's invoice discounting, where money is made available for the invoices that have been issued. So there are now creative ways that people are looking at debt. But I think that for you to raise debt and for you to leverage debt effectively, you have to build fund and very strong governance and financial management capabilities in-house. Because you don't want to raise money and then all of a sudden you have to liquidate the whole company because you can't pay back. So putting governance front and center, putting, strong financial management in-house. What I've seen is a lot of, these growth phase startups don't even have a proper CFO. What they have is an accountant playing a CFO job, right? At certain stages of the business, you need to reassess who is managing or, looking at the financial strategy in your company and ensure that that person actually knows the job and can help steer you through the phase of your journey that you're in. So again, that is really, really a very good option, but you have to have that capability to manage your debt payments, manage your finances, and ensure that governance is in place. And then finally, what was the last thing I said? I think that you have to also raise debt, particularly for certain parts of, you have to consider certain things when you're trying to raise debt. It could be you want to fund R&D, it could be just for your cash flows, it could be for varying reasons.
Thank you very much, OM, and thank you, Davy. So with that, we come to the fourth part of this conversation, the end of the fourth part of this conversation. So now I'm just going to sort of like go into the Q&A to see questions that the audience has left us, so we can discuss that for the next 30 minutes. And just as a quick reminder, if you want to get access to the State of Africa report, the State of Tech in Africa report, that's also known as SOTIA for Q1, go to insights.techcabal.com, insights.techcabal.com. So I'm just going to take a few questions from the audience. Let me see. So keep your questions coming. It's not over until it's over. So this question is from Bereng Seiso. It says, M&A between competitive companies or companies with synergies was the forecasted trend at the beginning of 2024. Has any of the data indicated a following trajectory towards that forecast? Now that sounds more like a question for TechCabal, but if you have any comments, please feel free to share. If you don't, then I'll just move on to the next question.
I'd like to just add that a lot of data from the African ecosystem tends to be very underreported, and you get to get a clear picture months after. So we are going to see more of this data down the line, because most companies hold off with announcing, maybe for regulatory purposes, or just, it could be ego reasons or whatever the case may be. Sometimes people don't announce stuff till months after. So I think you should just hold your horses. But yes, we are beginning to see, we are seeing a lot of M&As and, talks about M&As, because again, we're in survival mode. Quite a number of companies are going to be sort of collaborating and merging their infrastructure just to ensure that they survive these crazy times.
Yeah, thank you. OM, David, do you have anything to say to that?
Well, with the current survival ecosystem, it's also a great time for the different companies to take out their competition. So, and M&As are a very good avenue for that, because if you find a company that has the potential to become huge competition in the future, this is a very good time to actually just get over and do them in. So, but also there's more to it, getting new tech capabilities on your team, new customer segments, or rather than having to build a whole new customer segment, if a different company has already built that and it's an area that you are thinking right now that companies are struggling, is a good time to be able to make that approach and see if it works for the both of you. So I think we'll continue to see this in the near term, possibly the medium term.
Yeah, thank you very much, Davy. So before I go to my next question, right, from the audience, so just for everyone in the audience, thank you for staying with us so far. Welcome again for anyone just joining us. So you're going to see a poll appear on your screen. So now that poll is just for you to give us your opinion or your thoughts on Satya and also this TC Live. So please do well to answer the questions in the poll. It's just 4 questions. And yeah, so it helps us evaluate how much value you're getting from TC Live and all the other programs and initiatives we have, such as research and providing actionable insights for startups. Thank you very much. So I'm just going to go to my next question from Tolu. So Tolu says, will the move to venture debt not reduce the company's ability to scale? How do investors now think about structuring these deals? Davey, would you like to take a stab at that?
As Wem said, debt, a lot of times when you're taking in debt, debt should be focused. Like you're not just taking in the debt just because you think you need money. It's very different from just how you would run a venture round where there is no debt. So in this case, I think debt would not inhibit your ability to scale, especially if you're taking debt for a very particular reason and you understand how you're going to repay that debt back. I think it would actually be a good opportunity, especially now that there's reduced typical funding for companies, to actually think about debt, because it would actually give you an edge. You would be able to scale in a market where ability for other companies to scale is quite limited.
Thank you, Davey. OM. Any thoughts?
No, I don't have anything to add. David has answered that quite well.
Okay, fantastic. So the next question is actually for you, OM. So it's from Prestige Okafor. It says, in the context of business pivots, what are the indications that a business has outlived its existence?
I believe that it's pretty obvious. I understand that when you're in the arena, when you're that founder, sometimes they're not quite obvious. But where you find a situation that your customer base keeps on reducing, where your revenues keep on reducing over time, no matter how much you spent on marketing, your CAC keeps, your customer acquisition cost keeps on growing, while against the revenue keeps on dropping. I think it's time for you to start asking yourself questions, especially if your runway is becoming shorter and shorter and shorter. Don't forget that when you build a company, you're not just building a company for yourselves, you also have workers that and staff that you've recruited. So when you begin to foresee a near future where it is impossible to maintain the operations of the business and still, serve the customers, I think it's time for you to start thinking of other ideas on what to do.
Yeah, thank you very much, OM. And I'm going to ask my final question from the audience. So it says, how is the regulatory environment evolving in Africa to support tech companies, as this is a big issue that we have seen around? So I think that this is a very different topic, but if you have any, so this is about regulations, right? So it's about how is the regulatory environment evolving in Africa to support tech companies?
Maybe I say a bit something. I think that there has been a concerted effort by government and regulatory bodies to actually enact regulations that protect the customers, because let's not forget, regulations typically exist to protect customers, right? And not necessarily to protect maybe the incumbents or to kill startups. And we've seen that there's been a drive from the Startup Act to Nigeria, to Senegal, to Kenya, to South Africa, where recently South Africa just licensed 56 or 59 cryptocurrency companies. So I think that Africa is an interesting place. We don't lack that. We always have a policy for something. I think the biggest problem is typically the gray areas in those policies, where governments begin to make arbitrary decisions that affect startups negatively because of that, gray area where they haven't defined things. Say, for example, which is some of the things they try to solve in Nigeria is what is a startup? And then if it's a startup, how much are you meant to tax a startup, right? So over time, I believe that regulations and governments are beginning to see that you can't even grow your economy, your local economies, without the input of these startups that you're trying to regulate. And as such, there's now more of startup leaders and investors and government are beginning to work hand in hand to ensure that the regulations are more favorable. And again, remember that Africa's ecosystem is still very nascent, and it's going to take a bit of work. Unfortunately, some people are going to get burnt, but I think we are getting there in terms of regulations that support the growth of startups. And one of the things we are beginning to notice is where regulations don't work in a certain market, we find founders that are leaving and building the same products or potentially scaling to a different market. So things are definitely going to get better, and founders are finding creative ways to work around the regulations.
Thank you. David, do you have anything to add to that?
Yeah, I think Wem just dropped the mic on that one.
Okay. So thank you to everyone who filled the poll. So I still have one more thing for you to fill. Okay, so it's still like 6 minutes to the end of the poll, so keep filling that. You are going to see a post-event survey just pop up on your screen. So please fill that. Sorry, a little correction here. So the poll is about Sotia. The post-event survey is about this actual conversation, right? How did it make you feel? What value did you get from it? And all of that. So it helps us improve the quality of TC Live for you. So I believe you should be able to see the post-event survey on your screen right now, or maybe you're going to see it in the chat box. So you just fill that out. Thank you very much, and thank you for your time. Davy, do you have any final words before we go, based on everything we've discussed, considering the trends and patterns we've seen in funding and financing across African startups for this quarter just ended? Do you have any final thoughts? Anything you'd like to share?
I do think that we don't expect to see a very huge change within the next quarter. A lot of the fundamentals that have affected this first quarter will continue possibly into the next quarter. We've seen most of a lot around the world has not been changing, which means that the demand for prudent use of capital by investors will continue to be there, just like it was in the first quarter. But I also think this is a very good opportunity for a lot of startups to be able to build the important fundamentals for their growth and governance into their startups, and possibly come out of this with a very successful business, because we've seen a lot of the great businesses around the world being built, especially in economic downturns. When things are thick, that's the best time, because if you are able to survive this, then most likely when you come out the other end, you just come out stronger. So just for a lot of the founders, especially those that are listening to us today, this is a time to basically take a very keen look into the kind of business you're building, into how you're serving your customers, into how you're being able to make your business more sustainable. If those things are done the right way, then you should be able to basically survive this period and build a better business.
Thank you, Davy. Final thoughts?
I don't know how I can top what Davy has said, but I just say persevere. We know we find ourselves in interesting times, but I believe that it is only those that persevere that can eventually get to that phase where things, I mean, everything becomes right. And then just also finally adding that only, there's this cliche, where they say only the paranoid survive. And in this period, I need founders to be very paranoid in terms of their numbers. You're looking at the numbers weekly or monthly, ensuring that you're either growing or you're cutting down, the losses as much as possible. You're looking at the market, you're, listening to you're checking out the latest regulations coming from the regulators. You just have to be paranoid because you need to survive this period. I'm not saying go do crazy things. I'm not saying, do negative things, but I was saying put your ears on the ground, keep yourself in the right networks of founders, in the right networks of investors, so you know what exactly is happening. You can leverage their network, you can leverage the resources that they have, and you can, and then maybe finally, good advice today. I just summarize everything we said. Can be bad advice tomorrow, and bad advice today can be actually good advice tomorrow. All I'm trying to say is not everything you hear is implementable. It could work today, it could fail tomorrow, but always apply advice based on the context of your journey, where you are, because that's very, very important. Thank you.
Thank you so much, Davy and OM. So for those who probably joined us in the middle of this conversation, so Davy Ngugi, our guests have been Davy Ngugi, who is head of channels and production at TechWiz Nairobi, and OM Akban, who is head of investments at Seed Fund 2. Thank you so much, Davy and OM, for your time and for gracing us with your thoughts and insights in this conversation. For members of the audience, please remember to fill our post-event survey. You should see it in the chat box. You should see a link drop in the chat box for you to fill that. And also go download the State of Tech in Africa report for Q1 2024 at insights.techcabal.com. insights.techcabal.com. You should see a link to the website in the chat box as well. Once again, this event was produced by TechCabal Insights. TechCabal Insights is the event research and data analytics arm of TechCabal. They are an Africa-focused digital economy consultancy that leverages big data to help startups, investors, operators, big tech companies, government, and other ecosystem players on and off the continent to answer specific questions and implement key interventions. And lastly, do not forget to subscribe to our newsletters, TC Daily, which comes to you 5 days a week, just before 7 o'clock, and In a Jiffy, which comes to you every week from TC Insights. You should find a link in the chat box also to subscribe to these very important, very insightful newsletters. And what are we without you, the audience? Thank you so much for your time, for giving us your time, for giving us your energy, for asking us very insightful questions at the registration stage and even at the Q&A stage. Thank you so much, and I hope to see you again very soon at a similar TC Live. Thank you everyone for your time, and have a good Friday and a good weekend, everyone. Bye.